this here is one of our members' stories. So a small custom home builder doing about 5 million a year, he'd be doing okay for himself for several years. He's a smart guy, and like most builders, left school early to get into the construction industry. After eventually starting his own building company and transitioning into a business owner role rather than on the tools himself, he'd employed people, he had offices, he had a great reputation in the local area. The only downfall was the accounts. They never quite made sense to him, but like most builders in the industry, he just left it to his accountant to straighten out at year end. And when it came to year end, his accountant had a process in place that did include work in progress. The only thing is, it was the manufacturing version of work in progress. So at year end, they would simply guess a work in progress figure and add it on as an asset. And the year before he joined APB, it was a big year. His revenue grew by quite a bit. And at year end, the accountant did their best guess as to work out what the work in progress figure was. And the figure was so high that this builder ended up with $200,000 tax bill on this profit. And the problem gets worse because he didn't even have $200,000 to pay the tax bill. It made absolutely no sense to him how he owed all this money, but there was no cash left in the company from all this fictitious profits. Now, he ended up having to enter into a payment plan with the taxation office, and to this day is still paying off his debt, so to speak. So do not get caught out. Since joining APB, he now understands where the missing piece, where this money is missing, or where it went, and is never going to pay more tax than he has to again. And this is a perfect opportunity to walk you through a comparison. So let me walk you through how easy this is to overlook. What I've got again at the very bottom, you'll be able to see a little tab called Calculating WIPAA versus Not. And it's a very, 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 very simple version of a builder's profit and loss report. I'm actually going to zoom in quite a bit so that we're just focusing on Builder A. And it's not even Builder A. It's basically a normal builder's accounts versus the reality of their accounts. So a normal builder's accounts, let's be honest, they're just not calculating WIPAA, or it doesn't factor in WIPAA as an adjustment. And so if we look at this builder, so within 4 years, year one, standard building company, they ended up turning over just under $800,000 in sales revenue. And they've got costs of about $585,000. So they got a gross profit of $203,000, gross margin of about 26%. Fixed expenses in this example, I kept it dead simple, just constantly just making it about the 15% of revenue. Because obviously they're investing in the company, they're going to be taking on stuff, they're going to be doing advertising, that's how they're growing their revenue. So I've kept it quite standard over here. This obviously isn't the point. So fixed expenses, it then gave them a net profit of $85,000. So 10% net margin, cool, sweet, let's grow the building company. So in year two, they grow. They do more than double. They actually get to 1.9 million, just shy of 2 million in revenue. Of course, that means their costs go up, but it does leave them with a gross profit of $534,000, giving them a gross margin of 27%. This builder's awesome. How good is he? He's got fixed expenses just under $300,000 and a net profit of $238,000. Makes sense. That's how much cash was left over in the building company. Awesome, awesome. We're at 12% net margin. Let's grow again. Year three, we're a $4 million building company now. We've doubled again. Of course, the costs have gone up, but our gross profit, look at us go. We are 1.3 million. Our gross margin is 31%. Yeah, we're hitting the benchmarks. Yep, on paper, we're doing really, really well. Fixed expenses naturally have gone up. We've invested in advertising. We've invested in marketing materials. We've invested in people. But our net profit, we still got so much cash left over in this building company. We've now got a 16.42% net margin. Let's go for it. So you can see here, this building company, we've got an even higher revenue of 6 million. We've got costs of 4.18 million. And we got a gross profit of about 2 million. So you got 33% gross margin. We've got fixed expenses of about $930,000. And so our net profit is 1.092 million. So we got our net margin down here again. So this is a very typical scenario of what you see in a builder's accounts. What's missing? Well, we all know now, going through this course, it's the work in progress accounting adjustment. So let's look at reality. Let's look at over here. What is this builder's reality? If we would actually include the work in progress accounting adjustment, you're always going to have an adjustment. If you've got work in progress, there's no way all of your invoices are in on time. And in this building company's example, we're building new homes. So let's go through it. I'm going to zoom out a little bit so we can pop them side by side. So I've actually kept everything identical. We've got the revenue is exactly the same. The costs are exactly the same. I'm not trying to change the margins here, but you know what does change? The margin does change when we include the WIPAA. Because although in year one he had just under 800 grand's worth of sales revenue and just under 600 grand's worth of costs, they didn't make 200 grand of gross profit. There was still an uninvoiced amount of about 75 grand. That was a liability that this builder had. So what if we just did an adjustment of about 75 grand? That was a liability that we're still looking to pay out on. That's not cash, then we can't count that as profit. It did, in effect, actually bring down our gross margin. So this builder wasn't working on as nearly a good margin as he thinks he was. So that's problem number one. Problem number two is net profit. Can you see he actually severely overstated his net profit for year one? And you know what the sad bit is? He paid tax on that. So that's even the most gutting figure over there. And it's not even that big of money. We get into much bigger money by the end of the year. So let's go on over to the next year, because you know it all starts compounding. So we've got year two, again, exactly the same figures. He grows in the exact same way, just under 2 million in revenue. His cost just under 1.5. The thing is, his work expanded, his revenue expanded, his costs expanded, so did his WIPAA. This accounting adjustment, this liability has gone up as well. So now he's not just on the hook for 75 grand, it's gone up even more. We got way more jobs on the go. Subcontractors are late. We're front loading our jobs. There's about 185K of cash in this company. That's not mine. That has to go as a liability in my profit and loss. I'm not going to pay tax on this at year end. So let's get that adjustment in place. Okay. With that adjustment, our gross profit is now 350 grand, which actually takes our margin to 18%, not 27. So again, we're not even close to the benchmark that we should be at as a minimum for gross margin profitability for a building company. But can you see how we end up kidding ourselves when we don't have this adjustment in place? It's overstating profit, especially a net profit. You are paying way too much tax on money that's not yours and you did not make. So if we go back to this example of reality, the net profit for this builder is actually 52 grand. And again, absolutely tiny in terms of net margins, nowhere near the benchmark. Remembering our benchmark for a building company of net margin is at least 10%. It's going to be between 10 and 15% really, but we're not there. And we were kidding ourselves before putting in the WIPAA adjustment. Let's just look at year three. Let's just keep it going. Exact same revenue, exact same costs. But now our WIPAA has increased even more. We're dealing with big margins, big money over here. So naturally, we know that our WIPAA liability has gone up. We've got a lot more jobs on the go. People are late invoicing. We're front loading jobs. It means our gross profit is in the 800s, but our gross margin, we are increasing, which is great, because this is what I was showing you here. At least our costs are, I suppose, going down. I suppose our margins are going up is what I should say. But we still have a WIPAA liability to factor in. So it's actually 21% as opposed to the 31% we thought it was over here. Then we got our fixed expenses. We've kept them exactly the same for this example. So that didn't change. But the net profit was just under 250 grand, just 6%, not the 16% we thought it would be. Can you imagine paying tax on an extra 400 grand of profit that you never made? It is gutting and it does not have to happen. Let's compound it one more time. We're going to go into year four, exactly the same revenue as he did have, we've not changed anything, exactly the same cost. But now builder A, or this builder, has got an even bigger liability on his hand. He's holding on to about 700 grand's worth of cash that isn't his. And if we didn't do this adjustment, it would show over $1 million in net profit for the year. And we all know you didn't make that. We all know it on some level. We just don't know where it's going. But it was all this time, it was a liability. We did make a net profit, cool, just under 400 grand, not quite hitting our industry benchmarks. We still need to get it up there, but it was nowhere near as much as what we thought it was without this adjustment. And we do not have to pay tax on it.